two bank collapses spark a flurry of activity by financial regulators. The February jobs report was supposed to be the news event of Friday. Then, a bank crash happened. Hard to beat that in terms of impact. There's a lot to unpack today, so bear with me. Let's begin with the original protagonist of the day, the jobs report. At first blush, it's not promising for people worried about inflation. The number of jobs created was higher than the Dow Jones estimate. But go beneath the surface, and cracks in the foundation become apparent. Average hourly earnings didn't increase as much as forecast, while unemployment rate rose to 3.6%, above the expectation of 3.4%. In short, some good news, some bad news if you're an investor. There's something for everybody in there, as Liz and Saunders, chief investment strategist at Charles Schwab, put it. On its own, the jobs data was mixed enough for the Federal Reserve to consider hiking interest rates by 0.5 percentage point. But wait, a bank crashed. And not just any regional bank, but Silicon Valley Bank, the go-to for venture-backed tech startups. We can think of SVB as the first, high-profile, victim of higher interest rates. But the good thing, if there can be a good thing from a bank collapse, is that regulators decided to step in to protect deposits. The move suggests that the Fed recognizes the potential of broader contagion in the economy and may slow its hikes, just so it doesn't take down more banks inadvertently. At the time of this video's publication on Monday morning, financial regulators announced they were shutting down a second bank, the New York-based Signature Bank. That might explain why markets fell less sharply on Friday than they had earlier in the week when Fed Chair Jerome Powell suggested higher rates are on the table. On Friday, the Dow Jones Industrial Average lost 1.07%, the S&P 500 fell 1.45% and the Nasdaq Composite shed 1.76%. Of course, markets might still be digesting the shockwaves before selling off. But I suspect that hopes for lower rates as a result of SVB's collapse might be keeping markets afloat. Likewise, CNBC's Jim Cramer argued that nothing is more deflationary than the collapse of a debt-burdened bank, which might stay the Fed's hand. Indeed, the 2-year Treasury yield, reflective of investors' expectations of interest rates, plunged by 46 basis points in 2 days, the biggest move since the 2008 financial crisis.